This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. And as I start Fridays by saying, thank God it's Friday. It's been an eventful week. It's been an action-packed week, like always. We're coming to you live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Sonia and Nigel. Guys, hi, good morning.
Hi, Prashant. Good morning. Morning, Nigel. It is finally Friday, right? But there is definitely a lot of risk aversion in the markets. I mean, you can see it across the global screen. You can see it in our own markets. So it could be a bit of a tough Friday.
Well, that's right. Tough Friday, but it's been an exhausting week as well. So looking forward to the weekend. And Prashant, I told you yesterday, our boys are going to come out on top. And they did very, very well yesterday. But the test is on Sunday because India takes on New Zealand at Dharamshala. The conditions are very, very good for the New Zealand bowlers. But as I say yet again, our boys come out on top.
Our boys. No, galat. What is the right way to say it? My boy.
My boys.
My boys. As we were discussing.
My boys come out on top. But we got a test on Sunday.
But by the way, Nigel, I'm just...
venue is supposed to be stunning, right? I've never had a chance to really go to that stadium, but I heard it's one of the most beautiful in the world. So it's also going to be a privilege.
I think one of the highest.
It is the highest
ever. And I think we had our news, the sports editor who had joined us, and he said that is the match to watch out for. That's going to be an important one.
But we have market to watch out for today.
Absolutely. So let's just kick it off. And I mean, the markets are also sending us eventful signals, no less. First of all, just start with where we left off yesterday. The Nifty outperformed the broader market, the global markets, that is, but it still ended lower. So there was pressure, right? I mean, through and through, we could not kind of get our head into the green territory. We're down about 0.25% or so, but much better outcome because Asia was down and Europe was down and US futures were lower, and we kind of managed and got away with that one. But overnight, equities are down once again. So the Mastek ended almost about 1% lower. The big highlight was always going to be, as we've been highlighting for the last couple of days, Fed Chair Powell's speech, where he basically emphasized in one line, higher for longer, as a theme, that interest rates in the US perhaps will need to be held higher for longer. One thing, with this speech and what he said, without going into details, the November hike is off the table. We won't see a November hike, but the speech does indicate that later meetings in December and so on and so forth are live meetings in which there can be interest rate hikes. But in any case, that was the thrust, that was the message that we got. Actually, if you looked at the reaction last night, equities rallied immediately after the Fed Chair Powell's speech, but there was no help from sort of bonds in the US. And I think that is the reason why the rally in equities faded and we never really recovered after that. So the 10-year yield got to about 4.99% last night. I mean, it's kind of frustrating, right? I mean, for headline writers, you could have just said hits 5% since XYZ. But, well, we stopped short of that, 4.99. For all practical purposes, we're there at the 5% level. Oil prices are the other big one, right? They continue to inch higher slowly but steadily. Now we're above the $93 per barrel mark. Just circling all of this back in terms of what it means for the market, the global risk environment is negative. I mean, I think that is the takeaway, that is the handoff. It is not positive. It is not a constructive one this morning. So with that said, hopefully 19,500 levels hold. I mean, this is the level we've been putting out for the last couple of days. The low yesterday was 19,512, and then we saw a decent bounce from that particular point. If that goes, the next big support for the Nifty is at about 19,442, which is the 20-week moving average. That's the big one, a very long, slow-moving average, which is 19,442. Resistance, again, I mean, the upside comes in at two retracement levels, 19,673 and 19,778. So we'll see if we actually, those come into play or not. But again, levels we've put out for a while. This is the retracement of the fall that we've seen from the high to the low. Bank Nifty, that's the weaker of the one. Unlike the Nifty, which has not hit the previous lows, the Bank Nifty actually yesterday hit the August low of 43,600, right? And then it bounced. I mean, the low yesterday was below 43,600, but roughly in that area, we got support and then we bounced. The most optimistic scenario that I can see is that hopefully this is a double bottom for the Bank Nifty, right? And then we see a decent bounce from here. But looking at the risk appetite, etc., it doesn't look like that perhaps is the case. First support for the Nifty Bank then is that 43,600 level from where the market bounced about 150, 160 odd points. But after that, for the Nifty Bank, support comes in only at the 200-day moving average, which stands at 43,000, just under 43,200. And that is, again, by the way, not very far away, about a couple of percentage points, and we are there. So, as I said yesterday, you're getting bounces, but it's also very edge of the seat kind of trading environment. So the advice is just to kind of sit out. You don't have to compulsively do something every day. I would go with that view. 110 points lower is what the GIFT Nifty is implying, similar to what we had yesterday. And then, of course, through the course of the day, we saw a bit of a bounce. We'll see if we get that today as well. Sonia.
Oh, absolutely. And it's looking ugly, right? It's not looking good today. I mean, straight off the back, if we're going with a 100-point cut, there's definitely a lot of risk aversion in the market. And let's not forget, this whole geopolitical crisis has far from settled at the moment. Although there is an urgent appeal for a humanitarian ceasefire from people across the world, nothing has happened just yet. There is still plenty of damage both on the humanitarian front as well as on the financial front. And that is having repercussions in global markets. So perhaps, that is another reason why you're seeing this kind of risk aversion. So it is a sell-on rally market today. That's the way to approach it as we kickstart trade. The Bank Nifty has been the one that's leading the decline. So just keep an eye out on that. The Bank Nifty is testing its 200-day moving average. And, it's just at the precipice of that 44,000. It's actually slipped below 44,000. So keep an eye out on that. And if you look at all the parameters that we've had from across the globe, everything is in negative terrain. So the Dow is down 250 points overnight. The US 10-year yield almost, near that 16-year high. Risk aversion is back, so gold has been rising for 3 straight days now. Brent is back at $93 a barrel, and the Fed chair coming out and saying that inflation is too high at a time when Brent has been moving further, right, because of all the escalation of the Gaza crisis. So in that context, it's just better to sort of take a step back, be a little bit on the sidelines as we watch this, the market move today. It's not a buy on dips market, so, better to be a bit cautious. Also, you've had these FMCG companies come out with their numbers where the revenues are largely below what the street was estimating. So no great positive trigger from there either. Let's see, the important bit is whether we can arrest the fall at that 100-point knockdown or whether it gets worse from there.
Well, that's right, Sonia. That's going to be the big question, right? My sense is that maybe the dip gets bought into, but you can't carry those positions. We're getting into the weekend, and the global cues as well are on a bit of a tizzy. Brent crude prices are around $93 per barrel. The US yields as well, nearly at around 5%. Hawkish commentary coming in from the Fed. And also the commentary coming in on the Israel conflict. I'm looking at various international agencies as well. And the commentary is not comforting at all, for the good of humanity, for the good of the economy, good of everyone. We just want that conflict to come to an end. And hopefully, all the minds that are working on this, they come to some kind of conclusion. And we do see this, this entire thing end very, very soon. Getting back to the markets, well, the Nifty is in that range, 350-point range. And going by the GIFT Nifty opening, we're likely to start closer to around the lower end. So the dips, they're getting bought into, but the bounces are also getting sold into. Just take a look at yesterday. We started off lower. So if you bought the dip, you'll be very, very happy. But from the highs, we did come off as well. And the Nifty ended 57 points off the high, but the last tick was nearly around 75 points off the high. So that's because of averaging that we did see a bit of a recovery. The Nifty Bank, you would have thought, well, it started off in the red. We're off to the races with that big bounce that we got of more than 400 points. But we ended closer on 300 points odd. Short point is buy the dip, but make sure to, square off your position, because carrying positions is not really helping. It's a proper trader's market. The FIs, well, they're net short on the index. They've closed on 71% of their positions on the short side. And I just want to bring up 2 strikes for you. The 19,500 put and the 19,800 call. And these are the goalposts. Both of them, the total open interest is at around 73 lakh odd. And the premiums come up for you on the screen as well. So just plugging in the numbers, the support level is 19,500. Yesterday's low was 19,512. If you're an adventurous trader, maybe you look to buy the dip, keep a 50-point stop loss odd. But if you get that bounce, it would be prudent to book out with some profits as well, as was seen yesterday. On the upside, 20 and 50 DMA, that makes a bit of a resistance zone. The Nifty Bank is pat in the middle of the 20 and the 200 DMA. The sense you get is maybe, in fact, it wants to go down to visit the 200 DMA odd, but you'll need some bit of a positive trigger to see the Nifty Bank bounce up from here. GIFT Nifty, like we saw yesterday, suggesting a pullback. closer to around that crucial support of 19,500. If you're buying the dip, make sure you square off the position on the bounce, and stop loss, very, very crucial.
Absolutely. And, we are also heading into not a long weekend, but there's a holiday on Tuesday as well, right? So in that context, people may take Monday off and take that entire long weekend and may not want to keep their positions open because of the escalating crisis in West Asia. And that's another thing perhaps to keep on your radar.
Just one thing with regard to the broader markets, there were some signs of frothiness. And small caps and mid caps, they do well when interest rates are lower and when crude oil prices are lower as well. Now, interest rates are not showing signs of cooling off, and Brent crude prices is elevated. So I'll want to track that space because there have been many, many winners out there. But particularly these manufacturing-oriented companies, we'll have to keep an eye out on them.
The other thing, guys, is that if you look at what's coming through from the US in terms of earnings, right? Last quarter was blockbuster. This quarter is very mixed. So today, I think we'll get the Amazon numbers, which will give you a sense of what the consumer in the US is doing. But so far, what we've got is Netflix, Tesla. It's actually very, very mixed. So that's the other one, which has got influence on what the US market itself does.
Absolutely. And even in our own markets, right, earnings have been far from impressive. Perhaps just the banking space showing, some lease of life. Otherwise, most sectors have been muted this time, up until now. But let's kickstart the show and tell you what you'll get to see in the next 2.5 hours. First up, we have a view coming in from Amit Sachdeva of HSBC, who says that the FII outflows linked to the US bond yields rise has largely played out, leaving the geopolitical situation as the key unknown that may potentially weigh on the market and trigger risk aversion. He says if the current situation is largely contained, he thinks this makes the case for an imminent rebound in FII flows, given that growth continues to stand out and mid and small cap rallies have left the large cap space to outperform, supported by attractive valuations.
Okay, this is from Lawrence Belanco of CLSA, who is, of course, a chartist, who says that there are 3 key features to be aware of the daily chart of the Nifty, he says. The first is June's breakout from the trading range that lasted from October 2021 to June 2023. He adds, the second feature is the price momentum divergence seen between the July and September highs. He says the final feature to note is the 2 support levels of 19,200 and 19,230, and then 18,520 to 19,017. In conclusion, some patience is warranted as the market works its way through a corrective phase of its price momentum breaks registered in September.
All right, let's also get you some money market views. The rupee has been weakening quite a bit over the last many days, and Lakshmanan V of Federal Bank says the rupee traded in an ultra-thin range this week, with volatility at a multi-year low despite uncertainties in West Asia, coupled with a rising US 10-year yield, which is trading at a 16-year high. He expects the rupee to trade in a range of 83 to 83.48 for the next few trading sessions.
All right, on the bonds, Lakshmanan V says that tracking the spike in global yields, the domestic market reacted in line. He adds the move of the US yields above the psychological level of 5% will have similar impact in the domestic market. He's expecting the 10-year benchmark bond yield to trade between 7.3 to 7.43%.
Well, a lot of stock-specific action for you, and we'll get to that in just a bit in greater detail. For the time being, we'll run you through our top 10 list. We'll look at HUL, ITC, Metro Brands, Jindal Stainless. They are stocks that could react positively. While on the flip side, United Breweries, Mphasis, Tata Communications, Zomato, Havells, Voltas, all of them could be reacting to negative news flow overnight.
All right, Richard Harris is with us. He's Chief Executive Officer at Port Shelter Investment Management. Richard, good to have you with us here. Thank you very much for your time. It's in a way, I don't want to use the word stagflation, but it's a stagflationary kind of environment, isn't it? But is it? Because I'm using that word because yields in the US are at 5%. Oil prices are very high. And all of this while, for the last 1.5 years, people have been expecting a recession. At some point, we'll get a growth slowdown. It'll come. But it's all kind of very muddled and confusing. It makes sense for it. I mean, what are your top thoughts when you look at prices out there across asset classes?
Well, I think you cover a lot of ground there. One of the interesting factors, though, is that the US actually is in a Goldilocks scenario. We have inflation, at 3 or 4%. We've got growth at 2-3%. We've got interest rates, 5%, but that's probably where they should be. I think if you're looking at that as a snapshot, you'd say, well, I'll take that any day. Sorry about that. As a result, I think that this bull market is likely to continue for a while. Yes, there are lots of indications, as you say, that that we could see recession further down the line. But, Powell's not talking about reducing interest rates yet, and economies still seem to be going. So we're in a situation, I think, where this bull market is dying hard.
Okay. So if this bull market is all set to continue, if that's your view, what about a market like India? How are you positioned here?
Well, I think at the moment it really depends how the global economy is going. I mean, at the moment, yes, there are indications that things are slowing down, but, look at US earnings. They don't look too bad at all. Everybody's coming out with dire views in the future. And I have no doubt that eventually higher interest rates will kick in. I've no doubt that growth will slow down. And perhaps we might see some element of stagflation. But I think if growth does slow down, then we'll see inflation coming down, which is what it's intended to do. So it's a bit tricky to sort of say, yes, we want interest rates high because we want to calm down the economy, and then at the same time be worried about recession because we've got high interest rates. So I think we're in a situation at the moment. It's a bit of a phony war. The markets do seem to want to continue to keep moving. But most indicators, I think, aren't too bad at the moment, and certainly don't indicate that we're going to have a crisis particularly soon.
Hi, Richard. Morning. But then where does India feature? If you're looking at equities and you believe that the markets will climb the wall of worry, then where does India feature in that list?
Well, I don't think India is going to be any different from the rest of the world. If the rest of the world is looking as if it's holding on, then India will do well. I mean, I think India tends to do well. They've done well from things like the outsourcing movement. They tend to do well when the rest of the economy is due. The rest of the world's economy is doing well. And if we do see a big slowdown in the West, then obviously that's going to impact India. But I think at the moment, we're in a situation where it's really too early to sell. It's really too early to panic. Don't forget that the markets have survived both Ukraine and Israel in the last few years. That shows the kind of robustness that's in there. And once again, I point out that I'm not saying we're in a particularly good scenario, but we are in a scenario where this bull market is dying hard. And it's going to take quite a lot to push it off the track.
I have images of James Bond in my mind.
Well, Bruce Willis.
A few times. Well, no, well put though. It doesn't feel like it's kind of, the market's in its final phase, or it doesn't look like it's going to crash or anything of that sort. It doesn't give you the feelings at all. So we'll see. Maybe slow burn perhaps for a while, and then this continues. Richard, it's a pleasure. Thank you very much for joining us. Shorter chat today, but we'll come back to you for more later. We'll take a quick commercial break here. We'll come back with our research team, and we'll highlight the top 10 stocks on the CNBC-TV18 stock board coming up in just a bit.
Welcome back to Bazaar Morning Call. Plenty of stocks to talk about, but I think top of mind will definitely be HUL and ITC. So our resident expert is here. Mangalam joins in first up. Mangalam, how do the numbers look?
Well, for HUL, or rather all consumer companies this time around who have reported, two trends really stand out. One, there has been a slight miss on the top line for all the companies, but there has been a better than expected jump in the operational performance as well. HUL was no different. Revenues coming in just below 15,300. The street was working with a number above 15,300, but the EBITDA came in closer to 3,700 crores, and this compares with expectations of 3,600 crores, and the net profit was also above expectations. What's good about HUL's numbers this time around is a 700 basis points jumps that we've seen in the company's gross margins. And EBITDA margins have actually been better than expectations despite the company increasing their ad spends. Ad spends compared to last year are up by 65%, and as a percentage of sales, they're up by 400 basis points as well. What's not so good, however, is the volume growth. That came in at just 2% versus expected 3 to 4%, and the management also sees only gradual recovery in the rural business in a high competitive, intense environment. But going forward, with the second half of this year having some festive push as well, we can see a bit of a positivity, largely because the stock also is down about 8 to 10% from its 52-week high. Expect a wee bit of a bounce on HUL today.
Okay, all right. Mangalam got that on HUL. What about ITC? Kept you up late last evening. How was it?
Well, it didn't keep me up late last evening, largely because I was also watching a match on the side. But as far as the ITC stock, the numbers are concerned, there has been a miss if you look at the reported numbers, revenue, EBITDA, as well as net profit. The net profit has been in line, largely aided by other income. But that miss is mainly on account of non-core businesses. The core businesses, all of them have been extremely good. If you look at the cigarette business, volumes grew by around 6 to 7%, as against street expectations of 5 to 6%. The FMCG business grew by about 8%, but then again, all the other companies showed a slight miss in the FMCG top line as well. The EBIT in the FMCG business grew by about 37%. There was margin expansion, and hotels, that did extremely well. Remember, the previous quarter had the G20 summit as well. So on expectations of 15% growth, the hotel business revenue grew by about 21%. The weakness was mainly in the paper business that showed a 10% decline in revenues and 50% decline in EBIT. I see a wee bit of green on ITC as well, mainly because the stock has corrected about 10% from its highs.
All right, thanks a lot for that. Well, let's go across to Surbhi now. She's tracking United Breweries this morning. Surbhi, how does it look?
So it was a mixed bag. The revenues were above expectations, but it was a margin miss. The revenues grew 12% on a year-on-year basis. The gross profit margins, that came in at 44.5%. It improved sequentially, though, but down around 200 basis points on a year-on-year basis, and that was on expected lines. The EBITDA was down 16%, and the margins came in at 9.8%. Our expectations was around 11%, and that was largely because of higher OPEX spends. Now, the volume growth, that was largely in line with estimates, volume growth of 7%. And that too in a seasonally weak quarter. The premium segment volume growth that was strong came in at 10%. Now there's a con call today, so we'll watch out for the commentary on the OPEX cost front and also the gross margin trajectory going forward. But going with red for now.
Okay, thanks very much, Surbhi, for that. It's a tech-heavy day. I mean, in terms of the managements you will hear over the next 2 hours as well. There's a lot of tech. Rima is here. We're going to talk about Mphasis and Tata Communications to begin with. Rima.
Thanks so much for that. So let me start with Mphasis, where revenue growth has not picked up versus street expectations of a pickup, and 2, the order book has slowed down, the order wins. So starting with the top line, the company is reported flat revenues on a sequential basis. Street was expecting a growth. In fact, even the management commentary in Q1 is that growth in Q2 will be better than Q1. It will pick up, but that doesn't seem to have played out. The total contract value, or the deal wins as they're called, have also been the slowest that we've seen in the last couple of quarters. That said, the management does say we're seeing signs of bottoming out thanks to the stability in mortgage and visibility to growth given the sustained pipeline expansion and contract closures that are starting to gain momentum. Tata Communications, well, on the numbers per se, it's a mixed bag. Revenue slightly ahead of street expectation. Margins, though, are lower. Margins have fallen for the company, and they have been under pressure for the last few quarters because of the acquisitions that they did. The Switch acquisition got consolidated. There was M&A costs, integration-related costs, and therefore the margins fell on a quarter-on-quarter basis. And the second disappointing thing is the data revenue growth appears to have slowed down. In this quarter, the company's organic data revenue growth has come in at 10%, slower than the 14% that we had in the prior quarter. So I'm going to go with red for both of them. Back to you.
Okay, and keep in mind that you'll be hearing from both the managements, Tata Communications in a short while from now, and later on in the show, we'll have the management of Mphasis as well will be joining in at around 9:50 a.m. But let's go back to Mangla. Mangla, we're tracking Metro Brands as well as Zomato. Tell us more.
Yes, Metro Brands reported their numbers. The revenues, picked up. The growth in the revenues picked up to close to around 17% in this quarter. Yes, there was a mild moderation in gross margins, and that weighed on the EBITDA margins of the company as well. But nothing really to worry. The net profit was down by about 13%, but that's largely because of Cravatex's brands, which is the Fila brands that they own. And as a result of which, there was a 14 crore loss in this quarter as well. See a wee bit of green on that one. But importantly, the company's appointed Mithun Sancheti, who is the founder of Carrot Lane, on the board. See green on Metro Brands, but red on Zomato, largely because sources tell our colleagues that SVF Growth Singapore may sell about 1.1% stake in the company, and they will do that at a discount of anywhere between 0 to 2% of the current market price. As of last holding, SVF Global held about 2.17% stake in the company. So important to know whether this is just one of the trades or they will go ahead and do a clean out trade in the near future as well.
Okay, thanks a lot for that. Well, Surbhi is back with us to talk about Havels and Voltas. Why are you watching those, Surbhi?
So Havels, it was a disappointing set of numbers. The revenue growth was only 6%. The gross profit margin expansion was 240 basis points, which led to the EBITDA growth of 30%. Margins came in at 9.6%. Now, internally, if you look, the revenue growth across segments was weak. Cable segment grew only 6% on a year-on-year basis, whereas yesterday we saw Polycab, which reported a domestic business growth of over 30%. Lloyd, a revenue growth of 18%, but losses continue to expand in that segment. And the other segments as well, lighting, electricals and switchgears, all the revenues was in single-digit growth. The valuation tools are expensive over there at 50 times FY25 PE. For Voltas, it was a mixed bag again. The revenue growth was good, 30% on a year-on-year basis. Gross profit was sustained at 24.5%, but the EBITDA was down 30% due to higher other expenses, which were up 92%. Internally, the room AC segment, that did well in a seasonally weak quarter, that too. Revenue growth of 15% and margins of 7.7%. But the EMP segment, that's where the losses have continued to expand, and they've reported 4 consecutive quarters of losses in the EMP segment, and that is why going with a red for Voltas.
Okay, thanks a lot for that, Surbhi. Well, I'm looking at Jindal Stainless. The stock has corrected 15% from the recent peak, and the numbers are pretty much in line, so maybe the stock opens up flattish or mildly positive. Let's run it through the numbers. Top line a little bit lower because volumes are a little bit lower. EBITDA number pattern line, but since the top line is a little bit low and the EBITDA number is in line, the margins look better. The profit number got a bit of a bump up because of other income. The other important factors to track, the reason that the top line was a little bit lower is because on a sequential basis, volumes are down by close to around 1%. And the export market seems to be facing some pressure because exports as a percentage of the total sales volumes have come down to around 13%. In the first quarter, it was close to around 17%. The standalone EBITDA per ton as well came in at around 19,700 rupees. The management has been guiding from this band of around 19,000 to around 21,000 odd. So it's an improvement year on year, but on a sequential basis, a little bit lower. The net debt number has come down. Now, I'm talking about the net debt. I'm talking about the consolidated entity plus JUSL. So, that's come down to around 4,551 odd. And in terms of other good news, well, they've declared a dividend. Remember, this is a company that didn't declare dividend for many, many years. But in the last 3 quarters, they've declared a rupee apiece. So that is, well, fairly good.
Okay, well, let's do a quick recap of our top stocks. Stocks with positive news flow, there's HUL, ITC, Metro Brands and Jindal Stainless. While stocks with negative news flow, United Breweries, Mphasis, Tata Communications, Zomato, Havels as well as Voltas. Let's take a short break. On the other side, we'll be joined by market expert Hemang Jani for some fundamental stock analysis. We'll also connect with Amur S. Lakshminarayanan, who's the Managing Director and CEO at Tata Communications, to discuss their Q2 performance. Stay tuned.
Welcome back. Hope you're having a good Friday morning. Markets are likely to be tested when we start off trade today because the Gift Nifty is suggesting people back close to 90 to around 100 points, but we'll be starting off in that zone of around 19,500, and risk reward has been favorable at those levels. So let's see how it goes today. But plenty of stocks to discuss. And to help us out, we have market expert Hemang Chani who joins us. Hi, Hemang. Good morning. Well, plenty of numbers came in last evening. So let's address the two big names, ITC and HUL. What do you think of both those two numbers?
Good morning, Nigel. I think the HUL numbers were slightly, mixed bag. The volume growth was slightly less than market expectations, but the overall margin profile was much, much better. And what is interesting to see is that while rural demand is on a slower side, the outlook in terms of growth, in terms of margin is getting better. So when we see a little bit of recovery on the rural side, the company should do better. And in current environment, is clouded by the risk aversion. People would want to have some exposure to the defensive names like HUL, ITC, etc.
Okay, all right. What about the banking stocks, because that has been under a bit of pressure for the last couple of days. The bank Nifty, in fact, has been breaking down below key levels. If we do see another leg of a downslide in the market, do you think it's going to be led by banks? And if yes, what does one do with some of the large banking names?
Yeah, so Surya, good morning. Clearly, the bank Nifty and the banking sector is the one which is underperforming for many sessions now. And while the results per se will continue to look good, like for example, HDFC Bank numbers were pretty good, Federal Bank numbers were pretty decent. But the fact of the matter is that, when you have a selling or the risk aversion playing out and where the FIs have the large exposure to the banking names, there is going to be a certain amount of underperformance. I think if you see a meaningful correction, let's say about 5 to 7% in the bank Nifty, that would surely provide a great opportunity to buy into the, both mid caps and the large cap banks.
By the way, a specific view on Indocent. Hemang, it's one of those names where it's a long wait. A lot of diehard fans of this one, eventually expecting it to do very well. The numbers were good, and I saw some commentary which kind of indicated and pointed in that direction. But would you prefer some of these Indocent and Axis type of names over the large trio, which is SBI, ICICI, and HDFC Bank?
Absolutely. I think when we look at the numbers and valuations both, Indocent in particular, the PAT was up 22%, the loan growth was 21%, slippages, of course, they increased. But I think there is a lot of comfort in the current scenario towards Indocent Bank or Axis Bank, compared to maybe something like SBI or to some extent HDFC Bank. So I think if you really want to see some outperformance, it would be more sensible to have exposure to Indocent and Axis versus the SBI or HDFC Bank.
All right, just stay on, Hemang. We have, some interactions coming up, so I want you to listen in and then give your thoughts. It's our first corporate interaction. Tata Communications is on our radar. It was a mixed quarter for the company as revenue saw a growth, but margins contracted. Amur S. Lakshmi Narayanan, who's the MD and CEO of the company, joins us now to discuss more. Mr. Lakshmi Narayanan, thanks a lot for joining in. Can you just start by telling us what was the kind of organic growth that you saw in Tata Communications in this quarter?
The organic data growth was 10% year on year and 0.7% quarter on quarter.
Okay, 0.7% quarter on quarter. So there was a moderation. Perhaps the margins also further moderated by 60 basis points. Can you tell us what led to this drag?
Largely, no, I want us to look at the margins with a lens of our core business. And in the core business, the moderation has been less. And the core includes all of our data, digital portfolio, and the voice. And I had explained in the past as well, as we shift our portfolio more towards the digital portfolio for now has lower EBITDA. In fact, there's negative EBITDA in the digital business. and therefore it has that effect. The mix effect has an effect as we grow the digital business. But all of these products in digital portfolio has a glide path that will come back to the profitability, which is when the overall profitability will go up. The second factor is, besides the mix effect, is the investments that we have done in people. Also, the M&A related expenses that have come into this quarter. That's another factor. The third is in Switch got consolidated, and Switch, we had mentioned before when we did the acquisition, has negative EBITDA, and we are looking to turn that around, and that is going to take next year it will get turned around from an EBITDA perspective, and that will start to contribute more positively. So these are the reasons why we see the decline in the EBITDA margins.
All right, hi, sir. Good morning. Could you tell us what are the core business margins?
The core, when I define the core, it's purely Tata Comms, data, and voice. And if we, excluding the subsidiaries, right? So excluding, and subsidiary is another factor for the drag. So if I take all the subsidiaries out, it will be around 23% of in terms of EBITDA margins.
Okay. All right. Help us out with a few more details then. For how many more quarters will EBITDA margin stay below that guided band of 23 to 25%?
As I said, if I look at the core, so core, is a data business and voice business without the Switch. And the Switch has had an effect of margin dilution in this quarter. And it will take us a year to bring it back, or earlier if all things go well, to bring it back to at least EBITDA neutral, and then move it towards the direction of the EBITDA targets that we want in the media business. In the coming quarters, we also announced that we have had an accelerated closure of the Kaleyra deal, which we are very pleased with, because that gives us an opportunity to bring all the synergies of our Digo product and the Kaleyra together and exploit all the market synergies, because Kaleyra has significant market presence in the US and Europe and other markets, and gives us the handle on these markets much faster than what we anticipated, so we can start executing faster. But having said that, Kaleyra, it was a publicly listed company, so the data is available. Kaleyra is having a negative EBITDA, and that will also have an effect going forward. But when we did the Kaleyra announcement, we said the rationale was very sound, and also said that our efforts would be to make it EBITDA neutral within a year, and make it more towards a double-digit EBITDA in a couple of years' time. So, which is so if as all these things play out, is the reason why we said in the medium term for us to be in the 23-25% the range is a very valid ambition to have, and we will get there.
Got that, and that's quite detailed. But just trying to understand, what is medium term for you to get back on track with margins?
No, it's hard to, when we launched the Reimagine strategy in 2020, we were at 16% EBITDA margin, and we had put a medium-term goal to be at 21%, and we achieved it much ahead of time. So I don't want to pin this specifically down, but it will take a few quarters to get it back. And we are quite confident that we'll get it back to the 23-25% range.
Okay, so you will be able to sustain double-digit organic revenue growth as well, apart from getting margins back to 23 to 25%?
Macro is what it is. The indications only I will give are a few. Our funnel today is an all-time high. Having said that, in the last quarter, I said that the closures are getting delayed, and the same holds now as well. Some of the deals that we were hoping to close this quarter has got pushed out to the next quarter, and there is definite slowness in closing the deals. But having said that, because our funnel is rich, our first half order booking is better than last year's first half put together. We want it to be even higher, but it's not. But it's definitely better than the H1 of FY23. So we will continue to execute. The excitement on our part is that the entire story of digital fabric that we are taking to the customer, our digital fabric consisting of the entire connected infrastructure with our next-gen connectivity and all the overlay software-defined capabilities we bring, and the connected experience and connected solutions we bring, is resonating with the customer. And that is what we are most pleased with, because we are increasing our relevance. Our levels of engagements are going up. The $1 million deals in the funnel are growing. So we are moving in the right direction. Now, as far as the momentum is concerned, some of the macro will play out, but we are focused on the medium to long term, and some of the shorter term effects. Who knows? The conflict in the Middle East, how that's going to play out. It's very hard to double guess these things, but we will put our head down and continue in the path that we have set ourselves to.
Okay, all right, we'll leave it at that. Thanks a lot for joining in. Appreciate your thoughts and all the best for the quarters to come. That's Tata Communications, a beat on their revenues. And they say that the deal funnel continues to remain very strong. But we have a market to trade on our hand. So let's get back to that. Anuj is joining in now for a quick trade setup. He's here with us in the studio. And guys, by the way, I haven't carried either my breakfast or my lunch today because the treat is on Anuj. Anuj, congratulations on winning the Managing Editor of the Year award. And this is from what? The Journalist Association of India. So many, many congratulations.
Thank you, Sonia. Thank you. Thanks a lot. Well, you've always been nice to me, but thanks a lot. And you don't need me to win an award for lunch or, any kind of treat. That anyway is due, but thank you so much, Sonia. Coming to today's trade now, and, today I'm wearing green on green also because it's the color of Navratri today, and there's a hope that the market can perhaps recover, but hope is not a data point. So let's come to data points. The last 30 minutes of trade yesterday clearly gave you a hint that the market was preparing for a gap down. After a recovery, there was a bit of a collapse yesterday, especially in the bank Nifty, about 300 points between 230 to 330 yesterday, sort of, preparing yourself for the kind of opening that we had today. Now, the bank Nifty is looking very weak, and that's the problem point for the market. And not just HDFC Bank, even ICICI Bank has turned weak. And 200-day moving average on the bank Nifty now looks, almost something which can be tested maybe even today itself. Brent crude, of course, at 95, US 10-year bond yield crossing the 5 mark, dollar index above 106. Let's see if the market can survive all of this. The all-important level to track on Nifty is 19,480. The day after the war broke out, that day's low. In fact, let's look at some support levels. On the Nifty, 19,512, which was yesterday's low, will act as the first support, and then 19,480, the October 9 low, as I said. On the upside, the first resistance is 19,681, yesterday's high, and the bigger resistance is 19,750, the breakdown zone. I think the bank Nifty is the one to track because that's showing signs of a breakdown. The first support is 43,558, which is yesterday's low, and then the most important level, 43,191, which is the 200-day moving average. On the upside, 44,058 yesterday's high, and a long distance from there, then 44,233 options based. But this really is the index to track. 43,754 right now, 43,200 thereabout is the 200-day moving average.
All right, Anuj, thanks very much, and congratulations once again for that award. We'll take a very quick commercial break here. We'll come back and we'll get you our an exclusive conversation with Cipla MD and Global CEO Umang Bora. My colleague Shireen caught up with him. This is the future of healthcare industry. Stay tuned. That's coming up.
All right, let's take it straight to an important corporate conversation. Now, my colleague Shireen caught up with Cipla's MD and global CEO Umang Vohra, who said that India's top pharma and healthcare executives believe consolidation is here to stay. Although he stops short of commenting on any potential stake sale in Cipla, here's a slice of that conversation. Listen in.
Let's get the elephant out of the room, so to speak. You know, you're not just dealing with a company. You're dealing with an institution. You're dealing with an 85-year legacy. That is the legacy that Cipla enjoys. The question today is the radical transformation that Sujay spoke of. Are we likely to see that radical transformation mean that Cipla is no longer going to be the Cipla as we know it, and it is going to be sold?
So I'll just say this, that look, there's certainly a lot of news in the media about various transactions, interest. This is a significantly large sector for the country, and one to be proud of. I think the ethos of this sector is not going to change. I think care is still going to be deeply rooted in how India sees its role in the world. I can't specifically comment on any transaction in the public, but all I can say is that it's a fragmented industry, and one could expect that with the type of interest that's being shown, that there would be some amount of consolidation that could occur.
No, I understand, and I respect the fact that you cannot speak specifically about Cipla and whether or not there is a transaction in the making. But let's talk about some of the drivers that could potentially drive this consolidation. Size, of course, is going to be an important factor. Size will matter. It does matter. Upping the innovation quotient is going to be another significant thing. The challenges that pharma companies from India are facing in the US with the pricing pressure on generics, that potentially is going to be another driver for any potential deal to go through. What will drive consolidation? What will be the drivers for any potential consolidation?
Yeah, so I think that let's look at a couple of big themes that are going around the world, right? The first is people want to stay healthier for a larger portion of their time. They don't want to be sick, right? And so one of the biggest trends we're seeing that will drive consolidation in the segment is just this whole transition from illness to wellness, right? So you are going to track your own health, and that basically has the power to disrupt how we see healthcare today. Right? So we've always seen healthcare as something that's tending to the sick. We're going to see healthcare as something that's tending to everyone. So in comes digital, in comes the connect, in comes diagnostics at home, in comes medicine at home. So that's one trend. The second big trend we're going to see, in fact, this is a challenge for India, is that, we are the pharmacy capital of the world when it comes to chemical synthesis. We're not the pharmacy capital of the world when it comes to biological synthesis. Yeah. I think the future of therapy and the way we see healthcare is actually going to be a lot more of biology. It's going to be, chemistry to match biology, but probably a lot more of biology. I think that's going to trigger a lot of reallocation of capital from chemistry, perhaps, to biology, right? And at the central level, maybe some amount of thinking about healthcare. So that's the second big change. The third is this is the world of data, right? A lot of us companies have a lot of data, but we don't use it well enough. And there are a lot of these other smaller companies where data is still not central to what we do. So I think that's going to trigger a different way of looking at your business models. We don't necessarily within Cipla need huge manufacturing facilities anymore. A plant the size of this room can actually cater to what we've been doing with much larger plants. So a lot of this digitization, miniaturization of healthcare is probably going to happen. So I think those are fundamentally the drivers of consolidation. But, the biggest one here is, I always ask this question to everyone, and, Rahul and we've had discussions on this as well several times in the past. Who's going to pay for the innovation? Yeah. Right? So it's okay to say we have to be biologically sensitive, etc. But someone's got to pay for it. Innovation is costly. And so unless the affordable thesis of India expands significantly, or insurance expands significantly, and by the way, that's going to be a pressure point to consolidate as well. Because if there are less number of people who are going to pay for innovation, then the number of people who are bringing innovation has to consolidate. So I think those are the 4 key triggers.
All right, well, that's an interesting conversation with the top management of Cipla, and we'll continue to get you more from that as we go along. I think there's, 8 minutes to go for the pre-open session, and Hemang Jani is still with us. Hemang, just a quick any results which have kind of struck to you as outstanding or really poor, and where there is a bit of a mispricing which could play out? Astral, for example, sold off 6.5% yesterday. It's not a cheap stock, but the commentary, etc., was super. Although the numbers on actuals missed expectations by 3-4%. But the management, when we spoke with them, sounded as upbeat as possible. But Astral or anything else which comes to your mind?
Astral, the numbers were slightly muted. No doubt it remains a theme, particularly in the mid-cap category that people want to participate in. But I think unless you see the delivery and when you really give very high valuations to companies, there's very little scope for disappointment. So I think that, in the current scenario, definitely where the mid-cap and small-cap is the flavor of the season, one should really spot only those names where there is a delivery. So I think from that perspective, it makes sense to focus on some of the cement companies, because I think Ultratech, though the numbers were not that great, but I think many things are falling in place, be it pricing, be it the volume growth, and also the margin one. So I think cement as a space, one should surely focus on, and maybe some of the mid-cap companies could really give you good surprises, both in terms of operating performance and M&A.
All right, Hemang, final question before we let you go. United Breweries, the numbers are a little bit subdued. My colleague Subri was just telling us. What's your view on the stock at these levels?
Numbers are good on the revenue front, Nigel, but I think margin is where there was a bit of a disappointment. I do think that Spirit, we are over the weekend. There are matches, so people would surely want to participate there. So I think United Spirits is something that we've been liking. If you have some sort of a treaty playing out over the next, let's say, few days, weeks, that should also have some positive rub-off on United Spirits. So I think that's a name that we prefer at this point.
Okay. All right. Hemang, thanks for joining in. Appreciate your thoughts. Have a good weekend, by the way. Lots of sporting action this weekend as well. So it's going to be an exciting one. Let's dip into a quick break. On the other side, we'll have the pre-opening rates. Also, Mitesh Thakkar and Shrikant Chauhan will be joining in to give us some technical trades. Later, Hiral Chandrana, who's the global CEO of Mastek, will be with us to discuss the company's Q2 performance. Stay tuned.
Welcome back. This is a minute to go for the pre-open session to kick off in just a bit from now. Let's just take a quick look at what the GIFT Nifty is doing. Maybe we'll just sort of wait for the pre-open session, actually, which should be with us in a bit from now. 90 points, so I think we'll get a start around there. But will we get a repeat of the price action we saw yesterday? Through the course of the day, some recovery coming in. That's a critical point. Mitesh Thakkar is with us, and so is Shrikant Chauhan, to run us through what they're making of things and trades they'd like you to take. Gentlemen, good morning. Good to have both of you here. Mitesh, how are things looking? Repeat of yesterday, or you think it's going to be risk reduction broadly as we head into the weekend?
Morning, Prashant. I would not bet on a repeat of yesterday. In fact, yesterday, as the markets kind of pulled back or gave a bounce back after the week opening, we bought into put options of the Bank Nifty, and we maintain a negative stance. The only thing is that I would still want to see the Bank Nifty break the key support area of 43,400, 43,200. And I'm saying break because the odds and probability are higher on that side, looking at the indicator setup. So once that happens, then I think we'll go aggressively short with future shorting coming into place. But till then, I think to maintain some kind of a negative bias on the index, we have bought into put options for the expiry of November. Also on the Nifty, I would look at a test of 19,500 in case we start trading below that. Then 19,350 and 19,230, 240 zone comes into play. So I think we'll we are bracing for a good possibility, good chance that we'll head towards the lower end of this range, which is closer to about 19,350, and in the worst case scenario, even 19,240, 230.
Okay, all right, got that. Shrikant, what about you?
Yeah, good morning, Nigel. I think, see, like the markets are falling, but whenever it is falling to the extreme levels, it rebounds from the lower levels, because already a lot of these large cap companies, they have fallen to their extreme levels. They're already down. So whenever there is a extreme fall in the market, we see some recovery. And today also, in case if we see the market is falling to the levels of 19,450, 460, specifically because there the market is having excellent support. So in case if we see any fall towards those levels, we are expecting some rebound. So there we should look for taking some contra bets. But at the same time, on the higher side, yes, 19,650 and 19,700 going to act as major resistance for the market. For the Bank Nifty, 43,000 is going to act as major support. And there also, we should look for taking some contra bets in the market.
So what would your contra bets be? Shrikant, what's your stock list looking like today?
Yeah, good morning. I think mid-cap IT companies, they should do well. Most of these companies are recovering from their immediate lows. Most of them have completed their corrective patterns. So based on their formations, we are expecting these stocks to move higher. Persistent, LTIM, both are showing a lot of strength, but Persistent specifically looks good. Around 5850, 5800 levels. And in case if there is any lower opening, certainly we should look for adding this particular stock with a short-term view. We are expecting stock to move towards 6,000, 6,050. So it's a buy at current levels with a stop loss at 5750. And the other stock on which we are bearish is ITC. I mean to say it is in the range. It is not crossing the level of 465, 470, and it is not falling below the levels of 430, 35. So in case if there is any rebound during the day, then close to 455, 450 levels, look for adding some short positions with a stop loss at 465. We are again expecting stock to move towards 435.
All right. And Mitesh, what about you?
Good morning. I have more of sell calls today. Bandhan Bank and Wipro, I think both started some kind of a negative trend post their results. So I have sell on both of these stocks. Wipro is a sell with a stop at 401. And I would look at a price target of 383, while Bandhan Bank is a sell, and it was a sell yesterday as well. Now can be sold afresh with a stop at 235 for a target of 216. Also a sell call on SBI cards with a stop just above 800 rupees and a target of 770. And one buy call Chambal. Again, it's been a call which we've given earlier as well, but this one looks strong enough. That's a buy on a mild decline, say around 293. Buy with a stop at 286 for a target of 305.
All right, thanks a lot for that, gentlemen. Let's move on now. We have plenty of tech stocks on our radar, and Mastek is the one we're looking at. The company reported a good set of earnings for the second quarter. Their constant currency revenue growth the revenues were up both sequentially and year on year, although their margin dipped due to wage hikes. Hiral Chandrana, the global CEO at Mastek, joins us now to discuss this. Hiral, thanks a lot for joining in. Appreciate your thoughts. You know, I want to understand from you how the situation in the second half is going to pan out. What are the demand trends looking like? Are you seeing any slowdown at all in key pockets like, say, BFSI or any other segments? And, you know, what is the average growth that you can eke out in the second half?
Thanks, Sonia. Good morning. I am pleased to report some positive results quarter on quarter, like you said, as well as year on year. Our quarter on quarter for the whole business was 5.6% sequential, as well as 22.4 for the whole business. But even at an organic level, those numbers were a fairly healthy quarter on quarter, 2.7%, and closer to 20% year on year. What we are also pleased about is the order backlog, the 12 months order backlog. So we actually report that as well, because that's a true indication of the next 12 months, to your point about H2 as well. And those numbers were fairly healthy, again, you know, closer to 20% year on year. As it relates to kind of the macro environment as well as the next couple of quarters, see, for our size of business and the focus that we have in certain markets and certain capabilities, while the macro does have some bearing in terms of slowness of decisions and delays, but it is really the micro and the elements of which geographies and which capabilities that we're focused on. So we are continuing to do well in the US market. We've had a healthy organic growth. Our UK public sector, which is a very strong business for us in the central government, is showing a lot of resilience with demand and pipeline building up. And feel that we can continue to maintain these levels going into the second half of the year as far as growth is concerned, both on quarter as well as year on year.
All right. Hi, good morning, Mr. Chandrana. You have detailed a fair bit about what's going on in the past quarter and the path ahead, but I'm looking for a couple of numbers. Now, in the first half of the year, you've grown by 16.5%, and margins are a little bit south of 17% at around 16.8%. For the year, what do you end up with in terms of growth? And do margins get back to, say, the 17.5% by the end of this fiscal? You did it a few quarters ago.
Absolutely, Nigel. So basically, our Q2 had the impact of wage hikes and salary increments. It also had a small impact of the Biz Analytica acquisition, which operates at a slightly lower margin than the overall company. Having said that, we believe that as we've guided in the past, even though we don't give exact margin guidance, we want to maintain at a high teens level, right? Which is the 17 to 19% range that we feel comfortable with. We feel that the operating levers, if you look at our utilization, if you look at some of the metrics that we have demonstrated in the last 2-3 quarters, quarter on quarter, is at a healthy level. So that is going to help us going into H2 to improve our both our gross margin as well as EBITDA. So we feel confident that by the time we reach Q4, we get back to that range that we were in Q1, which is in the 17.5 type of range. But again, we want to do the right things and make sure that we are investing in the accounts, investing in our customers. Very pleased to inform that we were recognized by the Everest Group as one of the top 5 Oracle Cloud applications providers. So some of that we want to leverage to fuel the growth going forward while keeping the margins in that high teens range.
Hiral, good morning. Prashant here.
Good morning.
Could you talk to us about the deal pipeline? I think you've got we have the 12-month order book. How is that situation panning out? Because we've heard commentary from other companies, etc., who've told us that the near term is soft, but in terms of deal signings, etc., it continues to remain pretty robust. Is that what you're seeing as well, or is it different for you?
Yeah, no, we are seeing our pipeline. Of course, our order backlog has gone up, but our pipeline has remained healthy and has gone up in at least certain sectors, Prashant. So we, as you know, right, we have a large business in the UK public sector, and there's a lot of technical debt in various policy decisions and frameworks that we participate in. And that whole modernization movement to the cloud is a multi-year journey. And so we feel that that will continue to give us resilient demand going forward. We are still, in the grand scheme of things, scratching the surface on major markets like US. Healthcare as a vertical, which we are focused on both on the payer and provider side, we see some good demand there, both on the front office as well as on the back office, both on our Salesforce business as well as our Oracle Cloud business. And so we are seeing some good deal activities moving from 5 million deals to 10 million deals in those sectors as well. So, yeah, I mean, while there are some uncertainties in terms of time it is taking to close those deals, right? Many of these deals are taking maybe 2 months longer, 3 months longer than we anticipated. But the pipeline still continues to be there. In fact, our demand has improved in terms of H2, in terms of open positions to fulfill. So we are seeing a good near-term outlook in terms of demand as well as deal pipeline, Prashant.
So, and one point of concern, Hiral, has been attrition levels, right? Your attrition is still quite high. It's almost 19%, while many of your peers have brought it down to about 15 to 16%. Why do you think that is, and what kind of attrition levels can we look at over the next couple of quarters?
Yeah, so Sonia, I mean, as you know, most of the business that we operate in is essentially all the digital engineering, digital experience, and cloud transformation business, right? We have very little legacy, kind of manual type of business. So the skill sets and the niche elements that we operate in is typically on the higher end, a lot more complexity on our programs, a lot more, even if you look at some of the deal wins that we've announced, these are complex programs that customers are trusting Mastek in. So there is going to be a slight delta there in terms of the attrition levels because of the niche nature. Having said that, our training programs, our cross-skilling programs, even the leverage of generative AI in the last few months has picked up. We're making sure that we take care of our employees, which is why we did not defer any salary increment hikes. We executed that in Q2 as promised. And we will continue to bring that attrition levels down in the coming quarters to make sure that there's no impact on the customers as well.
Okay, all right, Hiral. Thanks so much for stopping by and giving us a fair sense about how business is shaping up. We look forward to having a longer chat with you sometime during the quarter about maybe your probable inorganic growth as well, since you have some cash in your books. Well, let's move on then. Let's get Mitesh back. He's joining to give us his 9:10 call. Mitesh?
Nigel, I'll go with a sell on Bandhan Bank. Keep a stop at 235 or just above it, and a target of 216 can be looked at.
All right. Well, thanks a lot for that. That's Bandhan Bank. But let's hop across to Sonal now. She has IGL on her radar. There's a bull versus bear case scenario, that's playing out. So let's go across to her. Sonal, morning.
Good morning, Sonia. Well, IGL was lower in trade yesterday. Today also it's under pressure. That's because of the new EV policy being rolled out in Delhi. Now there are contrasting views on that. While Jefferies has downgraded the stock to a hold with a target price cut from 565 to 465 because they believe with Delhi government submitting this particular policy on EV adoption by cab aggregators, delivery service providers and e-com entities could potentially impact 30% of IGL's overall volume starting from FY25 itself. The new geographical areas that will come about as well will not be able to compensate for the volume loss that they'll see FY25 onwards, and new volumes, so new geographical areas will be around 88% of IGL's volumes as well. They've downgraded the EPS estimates as well by 7 and 9% for the next 2 financial years, and they are also seeing lower valuation multiple because of the growing EV risk. So they think that new policy will be a risk for IGL valuations going forward as well. However, Citi maintains its buy. They have a target price of 560. They say that Delhi's EV policy for cab aggregators is closer to reality. It has been ongoing for almost a year now, the discussions around that, but there are many unanswered questions. There could be some challenges on ground as well. This segment, that is the CNG segment from cab aggregators, contributes 15% of IGL CNG volumes. In worst case scenario, nil consumption by this segment over long term could impact the discounting cash flows by around 5 to 6%. So they say that this is already priced in because yesterday as well the stock was down around 5%. Therefore, they think that the risk is priced in. They prefer MGL followed by IGL among other city gas distribution companies, and they're sanguine on IGL going forward as well.
All right, Sonal, thank you very much for that. So that's going to be in focus once again as we start this morning. But we've got Havells and United Breweries. We want to shine the spotlight once again on those names. Surabhi is here with both those two. Surabhi, hi, morning.
Good morning. So Havells, it was a disappointing set of numbers. The revenue growth was only 6% on a year-on-year basis. They did see gross profit margin expansion of 240 basis points, which led to an EBITDA growth of 30%. Margins at 9.6%, still lower than expectations. Now, when you look at the internals, the cables and wires segment where all the expectations lied, that grew only 6% on a year-on-year basis, unlike Polycab, where the domestic business grew over 30%. The Lloyd revenue saw good revenue growth of 18% despite being a lean quarter for the AC segment, but the losses continue to expand in that segment. Lighting segment remained flat. Electricals and switch gears also saw only a single-digit growth. The valuations for this is FY25, it's valued at 50 times PE. UBS has a buy rating with a target price of 1880. But they did say that soft consumer demand and limited B2B capacity has led the P&L drag for Q2. United Breweries, it was a good set of revenue growth and the volume growth, but the margins were a miss. The revenues were up 12%. Gross profit margins declined on a year-on-year basis, but sequentially have improved, and that was on expected lines. EBITDA was down 16% due to higher OPEX costs. Now, volume growth of 7% in a seasonally lean quarter, which was expected. Premium segment growth was of 10%. The con call is today, so we'll be watching out for commentary on higher apex costs and the gross margin trajectory going forward. BofA has a buy rating on the stock with a target price of 1680.
Okay, thank you, and sorry for rushing you. We have the market opening up on us, so let's get to that very quickly. The sensex is down almost 300 points straight off the back. The Nifty is down 100 points, so not looking good at all at the start. As we were telling you, it is cumulative factors of negative global cues, risk aversion across global markets, Crude prices have been surging. Gold has been moving up as well. All of that put together has caused down markets to fall about 100 points. What's leading from the front on the downside is HUL, down about 1.5%, the biggest Nifty loser, followed by ITC, which is down about 1%. So both FMCG names are down in trade, about 1 to 1.5% post their numbers. HCL Tech is the other one that's down 1.5%, and other heavyweights include L&T. There's Coal India. Coal India, of course, coming in for profit taking. It's been one of the strongest stocks in the last couple of months. Eicher Motors, HDFC Bank, ICICI Bank, Tata Motors are all in the red right now. So let's look at the gaining stocks then. Ultratech Cement, there was a brokerage upgrade over there. So Ultratech Cement is bucking the trend today. And that's it. Maybe LTI, Mindtree, Adani Enterprises a tad bit in the green. Tata Motors, they're going to be acquiring 27% stake in Freight Tiger. So that's also been in focus. Jindal Stainless is the one in the broader markets that is up 5%. Clearly one of the stocks of the moment post that numbers. The Q2 numbers that came through. So look at that 5% rally there. But otherwise, the market is it's not too great. The only good part is the first tick on the index was a cut of around 100 odd points. Now it is about 87 points. So we've restricted the fall to less than about 100 points, but clearly not a good start.
Well, HDFC Bank, that's going to be the mover today. Yesterday as well, it almost tested that 1500 odd mark and then it bounced, and that's got a large weightage. Today as well, it almost went to around 1500. If it wants to get to say around 1530 odd, that'll be a percent higher from here on, which will help the Nifty. So let's see how that goes. Jindal Stainless, as Sonia mentioned, well, those numbers, they look pretty okay. And also, the stock had corrected 15% ahead of its numbers. We'll be joined by the management at 10:45 a.m. today, exclusively to CNBC-TV18. So don't miss that conversation. A few more stocks are on focus today. United Breweries, well, it seems people drank enough beer, actually. Stock is up close to around 3% as we speak. And maybe Q3 will be much better because you have the festivities. You also have the World Cup that's underway. So that's one stock that's reacted positively. On the flip side, IGL, we gave you a bullish and bearish outlook with regard to brokerages. Well, for the time being, the bears are on top because the stock is down 4.5%. Tata Communications, growth a little bit tepid, margins as well a little bit lower. That stock as well is down close to around 2%. And Dabur is under some pressure as well, down close to around 1.5%. Voltas delivering very, very good growth on the top line. Unfortunately, it's not resulting in better margins, and that's why that stock is under some pressure. Sagar Cement was the other stock that in pre-open was a little bit higher. They're showing some bit of improvement on a sequential basis, so the street likes that, and the commentary as well was fairly good. Sagar Cement, but it's flattened out, up only around 1% thereabouts.
Nigel, so the market is starting on expected lines, lower, but down, not out. I mean, that's always been the case with the market here for so long. In the most challenging global kind of environment, we're now used to the market falling lesser. I mean, it'll fall, but it'll fall a lot lesser, just like what we saw yesterday. So the Nifty is at about 19,552. The low yesterday was 19,512. Broadly, 19,500. I mean, if you're able to hold on to that by close, I think that'll be fantastic. And I think on the Nifty Bank as well, the August lows, which is 43,600. Right, it broke yesterday, but we closed to 150 points on top of it. So 43,600 by 330. I think I'd take it. Let's just take a quick look at some of the stocks. Shakti Pumps, if you can have that up. It's coming up as the number 2 volume traded gainer. So it was up 20%, and it's up another 7.5% right now. What a mover this year. And almost 1,200 rupees now on Shakti Pumps. There is UBL, which is United Breweries, the beer company, 3% higher, 1,600 plus on that one. There is Ircon, which is up about 1.5%. Atul Auto is starting about 2% in the green. The stock's at about, 671 or so. The Sonata Software is up about 4%, 1145 on Sonata Software. There is Equitas Bank, which is up about 2%, 100 rupees there. What else? Aban Offshore and a few others there. But, you got the volumes, if you go down the list, which are not all that great. So I think we'll give it some more time. IGL is down 5%. Sonal was highlighting that earlier, just a while back. Bajaj Finance is down about 1%. There is Jai Corp, which is coming up with a 3% cut, just highlighting things with volumes. And Tata Communications, you heard from the management, is down about 2% as well. There is Dabur, which is, by the way, down another 1.5%. Was down weak yesterday as well. 518 on Dabur for now. Chennai Petro is down 2.5%. Stocks at about 584. Nuclear Software is down 2. By the way, market breadth is 2:1, still in favor of advances. So keep that in mind. Nifty cutting more of its losses. So we are down just 65 points now, 19,559 on the index. So this is just the first 5-7 minutes of trade. But already I mean, you're kind of seeing which way the thrust is. The thrust is basically picking up from the lows on a slightly upward kind of trajectory. Nigel?
Just one more stock, MMTC. We've been warning retail audience out there, be
10%.
careful of the low float.
Yeah.
Every time it sees a bit of a bounce, you're seeing that stock comes in for selling.
Yeah.
And now that's down another 10% and pending sell orders as well. So be very, very careful. Enjoy the markets, buy good quality names, but also keep an eye out on some of these stocks which have low float. We're not talking about the fundamentals about it, but you should be tracking that and keep in mind some of these low float stocks, they can move up. A few sessions ago it was 85 rupees. Now it's down to 64 rupees. And you can't get an exit. The door's closed.
Yeah, no, absolutely. Point well taken. And these are not just low floats, these are very low floats.
Yeah.
There are great companies with low floats, but these are like minuscule, right? I mean, hardly any shares traded. So it's kind of very easy to manipulate these stocks on the upward trajectory as well. I mean, all kinds of things, circular trading, etc. We're not saying that, well, that is at work, but the fact is these are more susceptible as compared to widely held stocks to be able to sort of do all of that. So MMTC, STC, ITDC, and a bunch more, I mean, which have basically seen sharp run-ups, all climbing down very sharply. Our market master of the day is Venugopal Garre, is Managing Director at Bernstein. Venu, good morning. Thanks for coming back on. Appreciate your time. The guest earlier on in the morning was saying it's a die-hard market. Actually, he was not referring to India, but he was referring to the global equity space. And he was saying, well, he used that phrase die-hard a few times. But I think it applies to the market here more than anything else. The strength has been unbelievable, isn't it? In the face of all of that, what is happening? Your thoughts?
Thanks, Prashant. In the way we've been sort of arguing on the market is, look, my Nifty target is around 19,000. Really doesn't matter because while the target might look lower than where the market is, I've generally been arguing for the fact that I'm still positive on the equity markets because I'm looking at things from a 2 to 3 year perspective where I'm looking at a cycle view. And that's why I don't want to be seen at this point of time, highlighting that I'm worried on the market. See, my contention is there might be drivers for sort of short-term corrections in the market, but then I do see and believe that this is a market where you buy those corrections. Now, a deep correction, of course, is not something that I anticipate. When I say deep is you see a 15% cut in the market sustaining it there. There could be 3%, 5% corrections, which could be episodic, driven by sometimes commodity prices moving up or some local factors driving that, right? So that's like the broad view that I have held. The second aspect to it is, if you were to just generally think through, I wrote that in my portfolio report as well. Has the market really done well over the last 2 years? Because see, this is not about 1 month, 2 month trading. Think of a 2-year bucket. Nifty 50 has given you a 2.5% CAGR. Next 50 has been flat over 2 years. What you basically see as returns is, the so-called SMIT, which is 8 to 9% up on a CAGR basis from its peak in 2021 end, right? So that's basically what has delivered you some returns. But then FD returns are 7.5%. This low risk returns are still generating you that much. So top 100 stocks in an average have generated you lower than FD returns. So does it really mean that we are sitting on the top of a very heavy return cycle for India? I don't think so, which also gives me that view that if your earnings are going to be somewhere down the line in the mid to low teens for a couple of years, there are still anchors to protect material downside for India. So that's the approach I'm using right now. Yes, I haven't really changed my Nifty target yet.
Okay, got it. Venugopal, hi, good morning and thanks for joining in. There is, of course, this huge humanitarian crisis that's currently underway, something that perhaps we as millennials or people of our generation have not seen, right, for a very, very long time. Just the scale of it, the escalation of the crisis over the last 10 days, and we don't understand what the financial ramifications, economic ramifications of this could be. Would that be a large concern for you? Because already we're seeing a lot of risk aversion, whether it's gold prices moving higher, whether it's Brent crude surging. Now, the Fed chair talking about inflation being too high, etc. How would you sort of read into all of this?
Yeah, so my read is that you're right. I mean, I know what you're referring to, especially the sort of mini wars happening in 2 different parts of the world, the second one being more recent. Now, the fundamental reality is that, I think the world construct is very different. The nature of wars are very different. They tend to get isolated in specific geographies without much of a global ramification, right? It's very clear that a lot of the developed world is willing to sort of help at the background rather than directly willing to participate. So what it means is that the usual risk in such episodes is, does it really percolate and become much larger into, let's say, a global war, right? When I don't want to use a word world war in that sense, but the reality is that will be a big risk for the markets, right? But I don't really envisage that sort of a situation happening at this juncture. And in fact, honestly, even if it happens, you can't really predict it or really position yourself for that sort of a situation. Because think of it from a perspective of portfolio investors as well. A lot of my client base basically run funds. They can't be in more than 10% of their portfolio in cash. So you have to really take a proactive portfolio call in any sense. You can't go to a zero or put all your money in fixed deposits, right? So that's an unfortunate reality, and you can't plan for these things. So I'm not really taking this as a base case that things will sort of deteriorate to such an extent that we need to worry. The second, from a war perspective, now the second thing is, does it lead to a situation where commodity prices sort of start to spike, from a short-term perspective because of some supply constraints emerging because of how things shape up? Yes, that would be a material cause for concern, at least for a short-term point of view, and that's something which India can't digest, right? So that's like a worry. The third thing is on interest rates. I'm not really too bothered. My view, which I've held primarily to a large extent, is that I don't think we have fully peaked on interest rates. The way things are shaping up in US, especially the way the economy is actually still very resilient. I spent almost 15 days in US just about the last 2 weeks. And to me, looking at how things are going on the ground, I could clearly feel that the economy is still buzzing. So the fundamental reality is that inflationary tendencies might still come through locally. Now, if that's the case, your interest rates haven't really, sort of peaked from a Fed sense as well. So what will India have to do? I think this time around, if rates go up globally, we have to follow maybe a 25 bips increase or a 50 bips increase over a 12-month view. That's what I have actually held through. But that's like incrementally, not so large a percentage change to honestly change the equations, from a point of view of how economic growth pans out. So I'm not too worried about the rate cycle. That's the way I would characterize it. Yes, there are risks to a large extent that you see in the part 1 and part 2, which is war and what happens to commodities, which we need to acknowledge, but you can't position for it.
Hi, Venu. Good morning. Venu, the Indian markets out here, the domestic flows have been splendid. So pat on our backs as well, because the SIP number is looking very, very good. The problem is the FI number, well, that's dwindling a little bit. And they sold in the past month as well. But there's plenty of money waiting on the sidelines. How are you viewing this, FI flow, the interest in the Indian markets? And also, more importantly, the mid and the small cap party is well and truly on. Are you seeing interest as well from foreign investors towards the broader markets here in India?
Yeah, so very valid questions and pertinent, because I had my round of very good meetings globally. So, just to highlight, yes, the last 1.5 to 2 months of small correction in terms of FI outflows that you've seen is more tactical. Honestly, the feedback globally is not about negative India. They're not really worried about India macro story, domestic cycle story, or the next 3 or 10 year story. It's more a period of consolidation, valuations having, sort of hit a sort of a ceiling at this juncture. So there is some episodic correction sort of happening at this juncture from point of view of flows. But $3.5 billion is not like a big deal in terms of, how allocations are shaping up. But the fundamental reality is that I do see a lot of money sitting on the sidelines. Now, this money sitting in the sidelines is not about new money getting created out there or new fundraisings. It is basically about allocations that most of these global/emerging market funds are yet to do into India meaningfully. See, passive weights increase is a different thing, where your China portfolios didn't do well, so you automatically ended up having India having a higher weight. Because of that's a very different thing altogether. I haven't really seen at this juncture very major active shifts in terms of weights. Part of that, as I highlight, is more because of the fact that capability building is required. Quite a few of them, used to look at a few large caps, but they realize that's not the way to manage the market if you're going to be playing only ADRs and buy an Mphasis and HDFC, right? That's not like the way to manage your portfolio. You have to basically be a bit more broad-based into India. This is where the conversations were. And I think that's what FII's next stint would be, thinking about how to broaden portfolio into the 150th stock, for example, in terms of market cap. Of course, 250 and beyond is still very tough for them in terms of liquidity. But that's like the next step. And we are actually having a lot of conversations around, on how they should sort of approach that sort of investing in India. nothing is going to change in 3 to 6 months. These trends in terms of being ready to invest in India, building capabilities, having manpower who understands India is at least a 2-year process. So you're going to see, some money coming in as corrections happen. But then even at the current level, if you have to see a lot of money, you need to see this to happen. And I think this is happening from an Indian construct.
Hire more people to cover those 150 next stocks. Because build capability, right, is what you said. But that's going to be interesting to watch, right, as foreign brokers start to cover, because typically now you got to go to you got to look for coverage, etc., especially if you're on the buy side for smaller companies, which perhaps will change. But will it change because these smaller companies would have already become big, or will they go down when they're still small? I think the latter would be more preferable. Your top ideas, Venu, from here, in terms of incremental upside, absolute incremental upside, if you can share a few names with us.
Okay, so I actually, was trying to resist giving names, but since they're a part of India portfolio, I guess it's okay to mention names rather than digging into details on them. See, the way I look at it is that, look, honestly, as you rightly said, it is also about coverage of stocks. So we don't really have too much mid coverage. It's also, something we would be looking at. But the reality is, I've got a 20% allocation to SMID. I don't really differentiate between SMID and large cap. So there's no argument we're making that, hey, shift from SMID to large cap. I don't think it really matters. These are very difficult to execute trades. We're pretty agnostic to a SMID or large cap. It is just about which business model is correct, where you can generate returns is what our current strategy is. So we have maintained a 20% allocation to SMID. Outside of that, I would probably argue that stocks which we think are alpha generators at this juncture amongst industrials is something like L&T. Which I think is a doubler over a couple of years in terms of a cycle view. So the story is not done yet. Outside of that, to play housing and building materials, I'm still pretty positive on building materials as a space. I have Ultratech as, a portfolio stock at this juncture. We're neutral on that stock from a house perspective, but it's in the India portfolio, just largely to play the 3-year view, not really the near-term sort of, issues around other aspects. Then consumer tech is a pretty heavy overweight for us. So we have stocks like Paytm Delivery, which is Paytm is recently added in the India portfolio, and Zomato. These three are we still willing to hold on for a while, but do acknowledge, I want to highlight that I'm not taking a 5-year view on these stocks. We typically take, a year or a quarter's view and then see how things evolve in these business models. So these are 3 stocks that are there in the India portfolio. Financial sector, has been a bit tough for us in terms of how it's shaped up. But laggards like HDFC, we're not willing to let go of that. So it's been in the portfolio for a while. That's something which we still think that would play out well for us over a 3-year view. So that's CFC Bank, basically, and then Axis. So there are 2 stocks in the very narrow, smaller portfolio in the financial sector at this juncture that we are holding. So these are a couple of names, basically, which are top of the mind for us in terms of how, we are building the portfolio.
Okay, all right. Thanks a lot, Venu, for stopping by and filling us in with those details and sharing some names as well that are part of your India portfolio. Look forward to having a chat with you rather soon. Well, let's move on then. Cyient, well, that's the next corporate on our radar. For Q2, the company deal wins was solid. Revenue and profit also surged. Although the FY24 company is lowering the guidance to the lower end, which was 15 to around 20%. Mr. Krishna Bodanappu, the executive vice chairman as well as managing director of the company, joins us on the show. Hi, Krishna. Morning. Thanks so much for joining in. Well, you've lowered the guidance a little bit to the lower end. Tell us what changed so much in the past quarter. And also earlier, you were saying organically you will grow around 7%, I think so. Now, what are you factoring in organically?
So good morning, and thank you for having me on the call. The reason why we are looking at the lower end of the guidance is, as you may know, the communications sector is a big part of our business. And it roughly constitutes about 22% of our revenue. The communications sector is going through a bit of a challenge with some of the programs being pulled out and delayed and so on and so forth, just because a lot of them are very capital-intensive programs. And with the current interest rates, etc., our clients are telling us that they'd like to push out the programs a little bit. So therefore, looking at the softness in the communication sector, if you just peel our numbers, the other 3 sectors, which is aerospace or transportation, sustainability, and the new growth areas, all 3 did very well. In fact, the aerospace sector, which is one of the largest parts of our business and something that we're really known for, grew almost 20+% year on year, and all of it is organic. So we're quite confident about those sectors, but the fact that there is softness in communications, which I think is also evident just in the general technology sector, made us a bit more guarded on the guidance and being at the lower end. In terms of organic growth, we're still budgeting about the same, maybe a tad bit higher, but it'll be in the same range. We don't see any significant change in the organic business.
All right, Mr. Burunappu, hi, good morning. Just on that aerospace, which you said has grown 20%, has done very well, has kind of offset the weakness in communications. I remember 2 quarters back when we spoke, you said that by the end of the year, you're expecting a cycle to start in that sector, which perhaps should be a bit of a super cycle. Do you see that? Is that developing now? Can you see it? And is that going to be a disproportionate driver for you from here?
So we are seeing some elements of that develop, especially around the defense elements of aerospace. We are seeing many elements of that develop. There are a set of new programs that are being awarded and kicked off and so on and so forth, with the military spend across the world actually increasing, including a number of programs that we've been working on. So we're seeing some elements of the early starts of that. The second thing that's also happening is, as you know, air travel has gone up significantly, which means that the maintenance, repair, overhaul, the sort of the aftermarket piece of aerospace is kicking in very strongly. And that's actually, that's a significant portion. That's almost 60% of our aerospace revenue. And that is picking up very strongly. And that's where we'll see continued growth till the super cycle begins. We're hoping maybe in about another 6-12 months, we'll see further meaningful acceleration. But I just want to say the aerospace business by Q4 should be back to its absolute peak, the highest it's ever been. So the recovery has been really good for us.
Okay, that's good to hear that the aerospace business is doing quite well. But you did mention briefly that the communication vertical is going through a big challenge. And, it's a steep slide that we've seen in your telecom business. I mean, it slowed down for the second quarter in a row. And you've also seen almost a 13% year-on-year fall in your, telecom vertical. How long do you think these challenges could continue, and how long before you get back to growth here?
We believe that this quarter is the bottom of that business. Essentially, in a very simplistic manner, the work that we do is really on the CapEx and the build part of a communications network. So as you can imagine, with the current interest rates, etc., much of the build has slowed down. And again, I'll say slowed down because, as you know, again, there is fiber optics, there is 5G. There's just a lot of imperative that has to still happen in terms of what needs to be invested for the comm sector. So therefore, our customers are very confident, and that's what they're telling us, that it's a slowdown till some of their financial elements are sort of start to make sense. But we're quite confident that we've seen the bottom. Now, Q3 might not be a significant growth quarter for comms, but at least it won't slide further. And Q4, definitely, we're confident we're back in a growth trajectory.
All right, give us 2 more numbers then. Your margins have improved and you have been guiding for that. I think in the quarter basis, it's up by close to 40 basis points. For the second half of the year, what kind of margins are you looking at? Point number 1. And point number 2, order intake has been fairly impressive, right? At around 180 to 200 million. Expecting that to continue?
Yeah, absolutely. I think on order intake, let me first answer that. I think on order intake, we're focused on a lot of the right areas where there is growth. The growth is not necessarily coming in the same areas that it would have maybe a few years ago. So I think it took us a bit of time to build the capabilities, excuse me, and the credibility in these specific areas. And I'm quite confident that we're built. So a lot of the growth is coming in these new areas, such as the technology areas, in automotive, in some of the digital kind of projects, etc. So we're still quite confident that will continue. On the first question on the second half margins, we said margins will improve 150 to 250 bits for the year, and we'll hold to that. I think there is some opportunities to invest in the certain things that we want to do in the second half. So that's why I'd say second half will not be very different than the first half.
Okay, all right. Second half won't be very different than the first half. Got it. Thanks a lot, Krishna, for joining in. Appreciate your thoughts and have a great second half. And a good weekend as well. Let's take a short break. Up next, RG Chandramogan of Hatsun Agro will be joining in to talk about their Q2 performance. We'll also connect with the Mphasis management to talk about their Q2 earnings. Stay tuned. Welcome back to Bazaar Morning Call. We have plenty of corporates lined up, but before anything, let's cut across to Finance Minister Nirmala Sitharaman, who's speaking at the Kautilya Economic Conclave. So some important takeaways from there. Let's listen in.
Outcomes from this kind of 2 or 3 days session where great minds are putting into the thought process, their own inputs. We need to have some thoughts to be shared globally as well. So I'm setting before you my little expectation from this 3-day session. But I'll also place before you those concerns which are in my mind even as I talk. Globally, we don't need to hesitate any longer to say the multilateral institutions, not just banks, development banks, but even otherwise, whether it's the UN, the Security Council, or any other, WHO, WTO, are less than effective from where they were made into institutions, from at the point when they were brought in. The level of effectiveness by their intervention that they were to bring in the global scenario is today at less than ideal position. Now, because they've become less effective, we've reached a stage where what we took for granted is no longer to be taken for granted. We thought that if there is a disruption somewhere, the WTO would come into play. If there is a huge big pandemic, the WHO would come to play. Similarly, in developmental agenda of different countries at different levels of development, there would be timely and periodic interventions with which you will see some change with the spirit of inclusiveness so that less developed countries will also have some traction towards achieving their aspirations. But we find that less effective in all across the board in all these institutions. So that's one factor that we keep before us. And in that, I'll begin by thanking Larry Summers and N.K. Singh for having come up with some kind of a document which all of us can use, in which I can see Nick Stern and others here, who have all participated to, in a very short period of time, apply their mind and come up with something which the G20 has appreciated, welcomed, and now it has tasked one of its own group to go into how the recommendations can be put to action.
All right, we'll keep cutting back to the Finance Minister and we'll keep getting you the important sound bites from there. But let's shift focus then to Hatsun Agro product. The company witnessed its margins improve after 8 quarters due to price increases taken in the last 12 to around 18 months. There was a huge jump in other income as well that's aided the company's profitability. Mr. Chandramogan, the chairman at Hatsun Agro, joins us on the show. Hi, sir. Good morning. Thanks so much for joining in. Well, give us a couple of numbers first up. You know, your gross margins have improved, and that's what's helped your margin performance as well. Do you expect margins to head a little bit higher from here on? What kind of a guidance can you give us for the second half of the year?
See, the first half last year we suffered with commodities bound for reconstituting of milk. Now we have enough milk, number one. Number two, our milk arrivals have improved by 20 to 25% in the month of September and October, which gives an indication that the second half cost will be under control. Not only that, we were not into dairy ingredient business That is one of the reasons for the growth of business being less with a single digit. Hopefully, the second half will have commodities also joining in, and mostly it will join in on the fourth quarter. But in the second half, commodities will also play a role because we have enough milk and we have enough products which we can sell in the market.
Mr. Chandramogan, can you tell us what exactly was the volume growth that you saw in this quarter? And what is the kind of average volume growth that you can do in the second half of the year?
Volume growth has started happening only by September with the procurement. October continues. The volume growth is likely to be somewhere around 20%. Volume growth is expected. And this is going to play a...
Sorry to interrupt you. I didn't mean to do that. But 20% volume growth you said would be for the full year, is it? I'm just trying to get the timeline.
No. The first half, we were gradually stepping in, and the second half has got that 20% procurement in hand as of now. So this will reflect in a better sales with the commodities, apart from the branded business, whatever we have. The second half revenue will be better than the first half. Margins will be sustained and maintained, not an issue.
So it's fair to say... So it's fair to say that the volume growth in the second half is expected to be 20%, right? That's what you're saying.
15 to 20%, because probably commodities will not be sold in this quarter. This quarter will not have a better price. So the next quarter only we will be selling the commodities in a big way. And the subsequent quarter we will be holding the stock. So it may be somewhere around 15 to 20%. You can say that.
Sir, good morning. You said you'll hold the margins, but from this 10 to 11% band, could you move to the 11 to 12% band? I mean, is there visibility?
We are already at 12.22 EBITDA. So the EBITDA levels can be sustained without any difficulty with the increased sales in the second half.
Okay. All right. Give us a little details on your balance sheet, sir. I think you were talking about bringing the debt down to around 500 crores in the next 2 years. Currently, you're at around 1,500 crores. You've done a rights issue, I think a QIP as well in the last 12 months or so. Where do you see this debt number end this fiscal? And by the end of FY25, does it come down to that 500 crores?
FY25-26, we are expecting it to happen for two reasons. Actually, we have a heavy depreciation, and also on the interest, there is an interest which is also about 30 crores. So that is not a cash outflow. The depreciation and cash inflow of interest itself is more than 400 crores per year. So that will be an inflow apart from the normal profitability what we are looking at. This year, fearing the last year problem, we also kept a heavy stock. So those stocks will get diluted over a period. So both put together, it will reduce the working capital burden and the debt together with a better profitability in the coming second half.
Just to follow up to what Prashant had asked you on margins, you said margins will sustain around these levels. So is it fair to assume that you will, your gross margins in Q2 were around 30%. So that's something that you can hold on to for the rest of the year. Is that correct?
No. I'm only saying EBITDA of 12% plus is possible for the second half. I'm not talking about gross margins and all that. Right.
Okay, so EBITDA of 12% is sustainable for the second half of the year. Got that. And in terms of your debt...
With incremental sales.
With incremental sales, yes.
Debt will start coming down with the dilution of dairy ingredients. By April, May, June, I think the debt will come to less than 1,000 crores in our opinion.
Okay, so less than 1,000 crores of debt by April of 2024. Got that.
So I'm talking about June 2024. The dairy ingredients dilution may take place and the debt will come to less than 1,000 crores, I'm saying.
Okay. And earlier you had told us that you intend to take the debt below 500 crores over the next 2 years. You hold on to that target, is it?
That's right. I'm talking about only the coming year we will be less than 1,000 by June. And another one more year is there where we can just bring it down to 500.
All right, we'll leave it there, sir. Good luck and appreciate you joining in with all of that perspective. And it's always a pleasure, sir, speaking with you. Let's just take a quick look at what the market is doing. Good time to do that. We're down about, 50-odd points. So it's basically 50 off the lows. 19,571 is where the index is trading at. The low was made early on. It was 19,518. So basically, it's a exactly 50-point recovery, and we're up 50 as well. Bank Nifty. Take a quick look at what that is doing. I think there is a very good recovery afoot. The low is 43,567, which is pretty similar to yesterday's low. Actually, almost sort of coinciding with the low yesterday, and then the bounce has come through. So let's see where we finally end. Just coming into the green, by the way, the Nifty Bank, as we speak, 43,751. Maybe take a look at some other stocks. Market breadth, which was 2:1 comfortably, that is narrowed now, and the gap is not that much. But just look at these names. IRB is up 4% now. Stocks at about 37. We've got Bombay Burma. That's a big mover. Bombay Burma is up 11.5%. Huge volumes, by the way, on Bombay Burma at this point in time. Bombay Dyeing is up about 5.5% as well. More on this in a bit from now. More stocks, etc., in a bit from now. Mphasis is the next company we are going to be talking about. They've reported a good set of numbers for the quarter gone by. Actually, we'll just come to the Mphasis numbers. Okay, I think we have the Mphasis numbers, the management with us. So new deal wins came through with the companies, and the company's maintained its F524 margin guidance as well. Nitin Rakesh is Managing Director and CEO at Mphasis. He's joining us right now to take some questions. Nitin, good to have you with us here. Thank you very much. Nitin, in the quarter, so as to speak, the revenues have been flat. Constant currency revenues are flat, whereas the direct business revenue is up about 0.3% again Q-on-Q. In the previous quarter, you had indicated that sequential growth in Q2 over Q1 will accelerate, which hasn't really played out. Could you tell us what happened and what is the outlook from here on?
Sure. I think basically what we said was we see the growth to be back-ended towards the second half of the year, and we definitely saw signs of stabilization in two of our segments that were definitely headwinded prior to Q2. So while TCV conversion to revenue has picked up, it is still lagging where we think it should be, even though pipeline to TCV conversion, picked up last quarter, and for the first half we have almost a 60% jump in our order bookings. So from that perspective, I think the uncertainty around conversion continues. There is higher scrutiny on discretionary spends that definitely played into some of this leakage in growth. However, we are pleased with the fact that because of the order book and the strength of our deal wins, we managed to stabilize the overall headline number, despite the fact that in this quarter again mortgage declined, even though not as much as it has in the past, and our visibility to that decline is behind us today. So, in terms of where we think we are, definitely made a lot of progress through the quarter in stabilizing revenue. Very pleased with the fact that we expanded margins, albeit with a small extent, but stability in margins has definitely been a key outcome of our efforts over the last few quarters as well.
Okay, that's good to hear. Nitin, hi, this is Sonia here. So you're saying that there is uncertainty around conversion, and some of your peers have mentioned that as well, higher scrutiny, with regards to discretionary spends. So in terms of decision-making from clients, has it improved compared to when we spoke last? And if yes, what is the visibility looking like in the second half of the year with respect to deal wins?
Hi, Sonia. I think issue is, uncertainty creates inaction, and the macro environment obviously has remained fairly volatile. It's one step forward, one step backward kind of environment. And with the continued spike in 10-year yields, it's very, very hard to call what will be the next action on the macro front, whether recession is going to be induced, how deep it will be. So it's very hard to take a business call based on a very uncertain environment. And I think what our clients have managed to do or continue to do is what we call relentless prioritization. There is a certain degree of digital duality under play as well, because on one hand, they're tightening discretionary spends, their scrutiny is high. Even though deals that are signed, are taking longer to ramp up, in some cases getting extended out from a duration standpoint. More importantly, I think there is also a very strong appetite from many customers on figuring out how they can benefit from implementation of some of these AI solutions. So I think it's an interesting environment. The outlook from our perspective is much more at this point in time micro-driven. Order book, account, vertical, geography. What can we convert? How quickly can we convert it? How many deals can we bring in? The pickup in decision making from the conversion standpoint is pretty okay in terms of pipeline to TCV. TCV to revenue, I think, is still not where it needs to be. It hasn't reverted back to where it was, I would say, a few quarters ago.
All right. Hi, Nitin and Manish. The last few quarters when you have joined us, I've been asking you all, what are you going to do with the cash? Now, we've seen some movement. You've spent around $130 million on that Sonic Partners acquisition. They did revenues of around $75 million. They've got it at around 1.7 times. Give us a couple of details. How much will it contribute in FY24? What about FY25? How do you see the revenues ramp up? And also, what is the margin difference of this acquired entity with Mphasis' margins?
So I can maybe give you a very quick thesis for the acquisition. I think, as you rightly said, Nigel, we've spent some of that cash in a strategic acquisition, which is capability accretive. Definitely brings us a competency from the Salesforce ecosystem. Fairly, well established that in the customer experience transformation landscape, combined with Einstein's AI offering, the Salesforce ecosystem has certainly become fairly attractive as we think about extending our experience design as well as contact center transformation archetypes. Secondly, it's also leadership accretive. We expect it to be growth accretive because there is a synergy revenue opportunity with our existing clients, not to mention that we've also acquired a pretty good set of marquee logos in financial services, healthcare, as well as media. I think the 75 million number is kind of the quarterly annualized number. I think the impact of that in current year will probably be less than half of that. And Manish can give us a little bit more breakdown on what we expect and when we expect the synergy to play out and what the margin profile is.
Nitin, on the mortgage side in the US, sorry, I think Manish wanted to comment. Manish, you wanted to sort of pitch in? Sorry,
I just wanted to add to what Nitin said that the Sonic Partners, which the name of the company is Silverline, we will look at them at driving the whole Salesforce business for us, and on the combined basis, we expect that business to generate somewhere in the range of $38 to $40 million in the current year, and this will get consolidated effective 1st of October.
And for the next year, how does it ramp up then?
It's a growth accretive business, and we haven't disclosed the numbers in terms of what the growth expectation is, but it will certainly be higher than the company expected growth rates.
All right. Nitin, I wanted to ask you, so far you mentioned the rates in the US, etc., but the mortgage market, which was the last trouble spot in 2006-07, it was a different issue, different era, I guess. But that's the market which is resilient still, with home loan rates in the US being 7, 8, 9%. What are you seeing there? Is it going to remain steady, or when things start to slow, that will be hit big time?
I think it's actually already taken a pretty big impact in terms of origination volume. So if you look at first mortgage, which is when you buy a home, you take out a mortgage for the first time, that volume is down fairly significantly in the last 12 months, up to as much as 60%, because 7.5%, 8% 30-year mortgage rate is more than 2x of what it was just about 6 quarters ago. I think where we've seen resilience is in the home equity line of credit, where you have equity in the house, you go and you take a loan against that. And the reason for that is that the housing prices have actually been fairly stable. So on one hand, volume loss on the origination, refinance market's obviously fairly dead, given that it's very hard to refinance at a high rate. Home equity line really stood up, and of course, diligence services has stood up as well. I think at this point in time, what we've seen in the last 3 to 4 months play out is as this downturn has extended on the mortgage origination side, many large mortgage providers, banks especially, have now realized that this is a good time for them to transform the way they run these operations. And we are a best-in-breed provider in that segment. So we've actually seen wallet share gains. We've seen bank captives turning over business to us and saying, you probably can run it more efficiently for us, and we can variabilize our cost versus having to run a fixed cost with headcount and infrastructure. So a large part of our optimism, at least on that line, even though it will take a while for it to get back to the peak of what it was for us a year ago. I think the large part of the optimism comes from the fact that we've managed to actually win new orders in that segment, given just our focus and our specialization in that space. And some of that will play out in Q3 and in Q4 in terms of sequential revenue growth.
Okay, Nitin, one final question, and if we can make it quick because we're running out of time, but I do want to get your view on board because, you know, the BFS segment is almost 50% of your overall revenues, right? Are you seeing any signs of an incremental slowdown over there? And what is the prognosis for the BFS segment in the second half?
Yeah, I think, Sonia, the regional banking crisis overhang continue to persist at least in Q2. We are seeing some signs of stability. It's hard to call what happens in a seasonally weak quarter, given that most banks are fairly used to a furlough construct. As we get into next year and budget, we start doing budgeting, reviews with customers. I think, given the resilient segments of consumer banking, asset and wealth management, I think there'll be more nuanced play on where stability arrives first and where we may see some sluggishness, especially in capital markets that are very much linked to deal activity. So a little bit more nuanced story on the BFS side. Hard to call a bottom on the macro, so we're not taking a macro view on that segment either. We're going account by account and making sure that we're able to win wallet share and market share.
All right, we'll leave it at that. Thank you so much, Nitin, Manish, for joining in, and all the best for the quarters to come and for the second half of the year. Well, let's get back to the markets now. The market is actually pulled back from the lows. Mitesh is with us. Mitesh, how are you feeling about the market? It's buying the dips, but actually it's all over the place, to be honest. But what do you see as a trajectory for the second half?
See, but the good thing is that the bank Nifty is stronger than the Nifty today, and that is kind of giving support. I think we are closer to support areas, but the structure is weak. So I would, change the strategy to buy from buy on dips to about sell on rallies, and closer to about 43,800, 850 is my selling zone on the bank Nifty. We already have some put options positions, but that is the area which I would want to short around and keep a stop above 44,100. Once we break 43,200, I think that will be the time when you might want to go aggressive on the futures side, and that breakdown below that 200 average could see a trigger or a stronger supply pressure on the indices. So wait for that. Till then, maintain a negative bias. On the stock side, I have a sell on Apollo Hospitals. Keep a stop above 49.80. Look for a target of roughly about 48.75 on the downside. While I would want to venture into a long position on Cipla closer to about 1200 with a stop below 1185 for a target of 1235.
Okay, all right. Got that. Mitesh, we'll take a quick commercial break here and we'll keep coming back to you for more. But we'll come back and put the focus on commodities. Manisha is going to be here with that in just a bit.
All right, let's focus on the commodity markets now. Manisha Gupta joins in. Manisha, what's the one commodity that you're tracking this morning?
Well, Sonia, I'm looking at the overall sector because it's been a week now when the conflict between Israel and Gaza began, and we have seen many of these commodities actually react on the higher side in sense of a safe haven. So most of the commodities are trading in the positive. The US dollar index also has come off its highs, and that seems to be supporting. And the street is now concerned that the conflict that is between Israel and Gaza, I beg your pardon, could actually spread to the nearby areas, and that has added premium to the prices. Apart from that, the street is also reacting to the Powell's speech yesterday, where he did talk about inflation concerns and labor markets, but also did not signal another rate hike in the month of November, and that's what the street is reacting to. While, of course, the markets are prepared for higher rate interest for a longer period of time. The US yields also rising to 5%, near 5%, which is the 2007 highs, is something that seems to be pinning down many of those commodities there. Well, the street also is looking at the Chinese data that has come in on the positive side. The infrastructure investment, the fixed income investments have been on the higher side. The 1-year and 5-year lending rates have been kept steady from China, which is near record lows, which was on expected lines in any case. And the strong third quarter GDP numbers, which came in on a higher side on a quarter-on-quarter basis as well, have been supportive for many of the industrial, non-agriculture commodities there. So take a look at the crude oil prices, and we have seen the Brent gain up by 2.5% in this week, and this is on top of 7.5% of gains that we saw in the previous week as well. Ditto goes for the safe haven buying that we have seen in case of gold. That one is trading at a 3-month highs right now. We are inches away from $2,000 per ounce, and gold is up 2% in this week after gaining 5.5% in the previous week. In case of metals, the best of the gains have come in for the ferrous space, where you have seen steel and iron ore gain anywhere between 1 to 2.5%. Copper prices have been surging as well, 1% on the higher side for that. And aluminum prices also have managed to be in the positive right now. That is because we have seen inventories decline, and the spot markets are looking at the lowest discount in last 3 years. So just about $9 to $10 a ton. So there is buying coming in on the ground, and there is safe haven buying as well, and that has been supportive for most of these.
All right, thanks a lot, Manisha, for that. Well, let's slip into a quick break. On the other side of the break, our special segment is The Economy. Lata will get chatting with Indraneel Pan of Yes Bank and Sakshi Gupta of HDFC Bank to get a sense of India's macro environment as Q2 earnings season unfolds. Stay tuned.